I am going to share something with you today that most investors will dismiss immediately. They will hear what I am buying and they will think I have lost my mind. They will point to the headlines, they will cite the negative sentiment. They will explain all the reasons these companies are uninvestable. And that is exactly why I am buying them. The greatest investments I have ever made were in companies that everybody hated. Companies that the market had left for dead. Companies where the consensus view was so negative that the stock price reflected a future far worse than what actually transpired. When I bought into a struggling fast food chain that everyone said was finished, the stock had fallen over 50%. Analysts were writing obituaries. The media was piling on. Every piece of news was interpreted negatively. And yet, within a few years, that investment returned over 200%. When I invested in a retailer that the entire world had given up on, people laughed. But they said e-commerce had killed the company. They said the management was incompetent. They said I was throwing money away. That position became one of the most profitable investments in my career. The pattern repeats throughout my history. The stocks that made me the most money were the stocks that nobody wanted to own. The stocks where I had to defend my position against universal skepticism. The stocks where being contrarian meant standing alone. Today, I am going to share 3 stocks that I have been quietly accumulating. Stocks that the market hates. Stocks that most investors would not touch. Stocks that I believe will generate extraordinary returns over the next 3 to 5 years precisely because they are so despised. Let me take you back to 2012, because what happened that year fundamentally shaped how I think about contrarian investing. I had been studying a company that had become a national punchline. The business had lost its way. The products were stale. The management had made a series of catastrophic decisions. The stock had collapsed from over $50 to under $20. Every hedge fund manager in New York was short the stock or had sold their position entirely. The company was Canadian Pacific Railway. Now, you might think a railroad is a boring investment, and in some ways, you would be right. Railroads are not exciting businesses. They move stuff from one place to another. There is nothing glamorous about that. But boring businesses can be extraordinary investments when they are poorly managed and then fixed. A railroad has incredible assets, physical infrastructure that took decades and billions of dollars to build, infrastructure that competitors cannot replicate. A railroad has pricing power because there are only a few options for moving freight across a continent, and a railroad generates enormous free cash flow when operated efficiently. Canadian Pacific was one of the most poorly run railroads in North America. Its operating ratio, which measures expenses as a percentage of revenue, was over 80%. The best railroads were operating at ratios in the low 60s. Canadian Pacific was leaving hundreds of millions of dollars on the table through operational inefficiency. I saw an opportunity that the market was missing. The assets were world-class. The competitive position was unassailable. The only problem was management, and management can be changed. I launched a proxy fight to replace the board and bring in new leadership. The incumbent management fought back viciously. They called me an activist agitator. They said I did not understand the railroad business. They said my plan would never work. The fight was brutal. It lasted months. It cost millions of dollars. There were moments when I questioned whether I had made a terrible mistake, but I won. We installed a new CEO, Hunter Harrison, one of the greatest railroad operators in history. Within a few years, Canadian Pacific's operating ratio improved by over 1,000 basis points. The stock went from $20 to over $200. My fund made billions. The lesson was not about railroads. It was about the power of buying hated assets and being willing to do the work to unlock their value. It was about having conviction when everyone else was running away. That same pattern is what draws me to the 3 stocks I am accumulating today. Great assets, terrible sentiment, fixable problems, massive upside when the market eventually recognizes reality. Here is what I am going to share with you. The 3 specific stocks I have been building positions in, why the market hates each one, and why I believe the market is wrong, and the catalysts that I expect will drive these stocks dramatically higher over the next several years. This is not theoretical. This is what I am actually doing with real money. significant positions that I believe will generate returns that far exceed what the market offers in popular stocks. Let me start with the second most compelling opportunity, and then I will build to the stock I am most excited about. The first stock I have been quietly accumulating is a major healthcare company that the market has completely abandoned. I am not going to name the specific company because I am still building my position, and I do not want to move the market against myself. But I will describe the situation in enough detail that you can understand the investment thesis. This is a company with over $50 billion in annual revenue, a company with a portfolio of products that generate enormous cash flow, a company with a pipeline of new drugs in development, a company that has been a blue chip holding in portfolios for decades. And yet the stock is down over 40% from its highs. The valuation is at a multi-decade low. The sentiment is among the most negative I have seen for a large-cap healthcare company. Why does the market hate this stock? First, there is litigation risk. The company faces lawsuits related to products that have been on the market for years. The plaintiff's bar is circling. Headlines about potential settlements appear regularly. Every piece of legal news is interpreted in the most negative way possible. Second, there is patent cliff risk. Some of the company's best selling drugs will lose patent protection over the next several years. Generic competition will emerge. Revenue from these products will decline significantly. Third, there are concerns about the pipeline. Analysts question whether the drugs in development will be successful. They point to clinical trial failures. They worry that the company cannot replace the revenue it will lose to patent expirations. These are real concerns. I do not dismiss them. But the market has priced this stock as if all of these concerns will materialize in the worst possible way simultaneously. The stock trades as if the litigation will cost tens of billions, as if the pipeline will fail completely, as if the company will decline indefinitely. Here is what the market is missing. On litigation, I have studied pharmaceutical litigation extensively. These cases follow predictable patterns. Initial estimates are always wildly inflated. Headlines scream about potential liability in the hundreds of billions, but the actual settlements are typically a small fraction of those initial estimates. I have commissioned independent legal analysis of this company's litigation exposure. The most likely outcome is a settlement in the low single-digit billions, funded from operating cash flow over several years. Painful but manageable. Not the existential threat the market seems to believe. On patent cliffs, the market consistently overestimates the impact of generic competition. Yes, revenue declines when generics enter, but branded manufacturers retain meaningful market share through authorized generics, patient loyalty, and reformulations. The decline is rarely as catastrophic as initial projections suggest. More importantly, this company has new products launching that will partially offset the patent expirations. The market is giving almost no credit to these new products because they are skeptical of pharmaceutical pipelines in general. But I have studied the clinical data. I have spoken with physicians who prescribe in the relevant therapeutic areas. These products have genuine medical value and commercial potential. On the pipeline more broadly, pharmaceutical drug development is inherently uncertain. Failures happen, but this company has dozens of programs across multiple therapeutic areas. The probability that everything fails is extremely low. Even a few successes will generate billions in new revenue. When I put together all of this analysis, I see a company trading at 8 times earnings with a 3% dividend yield. A company that generates over $10 billion in annual free cash flow. A company that will still be highly profitable even under pessimistic assumptions about litigation and patent cliffs. The risk-reward is asymmetric. The downside is limited because the valuation already reflects terrible expectations. The upside is significant if the litigation settles reasonably, if the pipeline delivers even modestly, if the market simply recognizes that this company is not going to zero. This is exactly the kind of opportunity I look for. A great business trading at a terrible valuation because of fixable problems and excessive pessimism. I have been building this position steadily and will continue to add on weakness. The second stock I have been accumulating is a financial services company that the market has left for dead again. I will not name the specific company, but the situation is illustrative of why contrarian investing works. This is a regional bank with over $100 billion in assets. A bank that has served its community for over a century. A bank with strong deposit relationships, a solid loan portfolio, and a history of conservative management. And yet the stock has been cut in half over the past 2 years. The valuation is at levels not seen since the 2008 financial crisis. Investors have fled the sector entirely, unwilling to own any regional bank, regardless of fundamentals. Why does the market hate this stock? The regional banking crisis of 2020. 3 destroyed confidence in the entire sector. Silicon Valley Bank, Signature Bank, and First Republic all failed within weeks. Deposit flight became a self-fulfilling prophecy. The narrative shifted to regional banks are uninvestable until proven otherwise. This bank suffered collateral damage despite having fundamentally different characteristics than the failed institutions. Its deposit base is stable, comprised primarily of long-term customers with multiple product relationships. Its loan portfolio is conservative, focused on traditional commercial and residential lending. Its interest rate positioning was prudent, avoiding the duration mismatches that destroyed other banks. But the market does not care about these distinctions. Regional bank is a scarlet letter. Institutional investors have been forced by risk managers to reduce exposure to the entire sector. Individual investors have been scared away by apocalyptic headlines. The selling has been indiscriminate. Here is what I see that the market is missing. First, this bank is actually benefiting from the crisis. When Silicon Valley Bank and First Republic failed, their customers needed somewhere to go. Some went to the mega banks, but many preferred to stay with a regional institution that understood their needs. This bank has seen deposit inflows from customers fleeing less stable competitors. Second, the earnings power is intact and potentially improving. Net interest margins have compressed, but this bank's funding costs remain below peers because of its stable deposit base. As rates stabilize, margins will recover, and loan demand remains healthy in the bank's core markets. Third, the regulatory scrutiny that has burdened the sector is actually a competitive advantage for well-run banks. Weaker competitors are being forced to shrink, to exit businesses, to accept merger offers at distressed prices. The banks that survive this period will face less competition and better pricing power. Fourth, and this is the catalyst that excites me most. M&A activity in regional banking is about to accelerate dramatically. Dozens of regional banks are too small to absorb the increased regulatory costs they will need to sell. The buyers will be stronger banks like the one I am accumulating. These acquisitions will be highly accretive because the sellers have no leverage. The stock trades at 70% of tangible book value. That means I am buying $1 of assets for 70 cents. I am paying less than 8 times normalized earnings. I am getting a 4% dividend yield from a company that has paid dividends continuously for over 50 years. If I am wrong and regional banks face continued stress, my downside is limited because the valuation already reflects a distress scenario. If I am right and the sector recovers, the stock could double or triple from current levels. This is another example of buying what everybody hates. The asset quality is fine. The management is competent. The competitive position is solid. The only problem is sentiment, and sentiment eventually changes. Now let me tell you about the third stock, the one I am most excited about. This is the position I have been building most aggressively, and the one where I see the greatest upside potential. The third stock is a consumer company that has become synonymous with corporate failure. This company was once among the most admired brands in America. Its products were in every household. Its advertising was iconic. Its market position seemed unassailable. Then everything went wrong. Management made a series of disastrous acquisitions. They paid too much for businesses that did not fit. They took on debt to fund empire building instead of returning cash to shareholders. They lost focus on the core brands that had made the company great. The stock collapsed down over 70% from its peak, down to levels not seen in 20 years. The company has become a case study in business school courses about what not to do. And yet, I am buying aggressively. Here is why. The core brands are still valuable. Consumers still buy these products. Market share has stabilized in most categories. The brand equity built over decades has not disappeared just because management made mistakes. The company has a new CEO who understands what needs to happen. He has sold the distraction businesses. He has paid down debt. He has refocused the company on its core categories. He has cut costs without damaging the brands. The turnaround is working. Revenue has stabilized. Margins are improving. Free cash flow is rebuilding. The company that seemed destined for bankruptcy 18 months ago is now solidly profitable and delivering ahead of schedule. But the market has not noticed. The stock is still priced for failure. Analysts who were burned by the previous management refuse to upgrade their ratings. Investors who were crushed by the decline refuse to look at the company again. The trauma of the collapse has created persistent aversion. This is exactly the setup I look for. Real operational improvement that the market refuses to recognize because of anchoring to past performance. Let me share some specific numbers that illustrate the opportunity. 2 years ago, this company had a debt-to-EBITDA ratio over 6 times. Highly leveraged, bordering on distressed. Today that ratio is under 4 times and declining. Within 2 years, it will be under 3 times, which is conservative for a consumer products company. 2 years ago, margins were compressed by integration costs, restructuring charges, and operational chaos. Today, margins are within 100 basis points of pre-crisis levels and improving quarter by quarter. 2 years ago, the company was losing market share across its major categories. Today, market share is stable or growing in categories representing over 80% of revenue. The story has fundamentally changed, but the stock price has not caught up. The stock trades at less than 10 times the free cash flow I expect the company to generate next year. A consumer products company with strong brands, stable market share, and improving margins should trade at 15 to 20 times free cash flow. If I am right about the turnaround and the multiple normalizes, the stock doubles. If the turnaround exceeds expectations and the multiple expands to peer levels, the stock triples. The downside is limited because the current price already reflects a deeply distressed scenario. The company would have to reverse all of the progress it has made and return to the worst days of the crisis for the stock to fall meaningfully from here. I have studied consumer turnarounds extensively. When they work, they can generate extraordinary returns because the market is so slow to recognize improvement. The stigma of past failure takes years to fade, even when the fundamentals have clearly changed. This is the opportunity I see. A genuine turnaround in progress, priced for failure. With years of positive earnings, surprises ahead as the market gradually recognizes reality. Let me now step back and share the principles that connect these 3 investments. The first principle is that the best returns come from owning what others cannot own. Institutions face constraints that prevent them from holding controversial stocks. Risk managers impose limits on sector concentration. Investment committees reject ideas that generate uncomfortable headlines. Career risk dominates investment decisions. These constraints create opportunities for investors who do not face them. When institutions are forced to sell regardless of price, someone has to buy. That someone earns the returns that the constrained institutions were forced to abandon. Each of my 3 positions benefits from institutional constraints. Healthcare companies facing litigation are automatically excluded from many portfolios. Regional banks are off limits for any fund that emphasizes safety. Turnaround situations are too risky for investment committees worried about short-term performance. The second principle is that valuation matters enormously. Buying a mediocre business at a cheap price often generates better returns than buying a great business at an expensive price. The margin of safety provided by a low valuation protects against errors in analysis and unexpected negative developments. All 3 of my positions trade at valuations that embed minimal expectations. The healthcare company trades at a discount to the market despite stable cash flows. The regional bank trades at a discount to tangible book value despite solid fundamentals. The consumer company trades at a discount to peers despite improving operations. This valuation cushion means I do not need heroic assumptions for these investments to work. I just need things to be less bad than the market expects. That is a much lower bar than needing things to be great. The third principle is that catalysts accelerate returns. A cheap stock can stay cheap forever without a catalyst to drive re-rating. Identifying what will change sentiment is as important as identifying the fundamental opportunity. For the healthcare company, the catalyst is litigation resolution. When the uncertainty is removed, the stock will re-rate higher. For the regional bank, the catalyst is M&A activity. When the company announces accretive acquisitions, the market will recognize the value creation opportunity. For the consumer company, the catalyst is continued execution. Each quarter of improved results will chip away at the skepticism until the turnaround is undeniable. The fourth principle is that patience is required. Contrarian investments often take longer to pay off than anticipated. The market can stay irrational longer than you can stay solvent. As the saying goes, I size these positions knowing that it might take 3 to 5 years for the thesis to play out fully. I do not use leverage that would force me to sell at the wrong time. I maintain liquidity to add to positions if they decline further before they recover. This patience is a competitive advantage. Most investors, especially professional money managers, are judged on quarterly or annual performance. They cannot afford to be early. They cannot afford to hold positions that underperform while waiting for catalysts. I have structured my fund and my personal finances to be patient. This allows me to buy when others are forced to sell and hold when others are forced to abandon positions. Let me now address the risks to these positions, because every investment thesis has vulnerabilities. For the healthcare company, the primary risk is that litigation settles at the high end of the range. If the company has to pay $20 billion instead of $5 billion, that would be extremely dilutive, and the stock would fall. I have analyzed the legal situation extensively and believe this is unlikely, but I cannot be certain. For the regional bank, the primary risk is a commercial real estate crisis that causes credit losses to spike. The bank has exposure to office and retail properties that could face stress if the economy weakens. I have studied the loan portfolio and believe the exposure is manageable, but credit cycles are unpredictable. For the consumer company, the primary risk is that the turnaround stalls. If market share starts declining again, if margins stop improving, if the new management proves no better than the old, the stock could fall further. I have conviction in the CEO and the strategy, but execution risk is always present in turnarounds. In all three cases, I believe the potential upside significantly exceeds the potential downside. But I am not pretending these are riskless investments. They are contrarian precisely because real risks exist. The key is that the prices already reflect those risks, and then some. Let me share some thoughts on how to think about position sizing for investments like these. I never put so much in any single position that being wrong would be catastrophic. Even my highest conviction ideas receive no more than 10 to 15% of my portfolio. I have seen too many investors blow up by being right about the direction, but wrong about the magnitude or timing. For these three hated stocks, I have built positions in the 5 to 10% range for each. Large enough to matter if I am right, small enough to survive if I am wrong. Combined, they represent about 20 to 25% of my portfolio, which is significant but not reckless concentration. I also maintain substantial liquidity. If these stocks decline further before they recover, I want the ability to add to positions. Some of my best returns have come from averaging down on positions that the market continued to hate before ultimately recognizing value. The psychological challenge of contrarian investing is severe. When you buy what everyone hates, you immediately face losses and criticism. The positions underperform, the headlines remain negative. People question your judgment. There is immense pressure to sell, to cut losses, to admit defeat. Surviving this pressure requires conviction based on analysis rather than hope. I do not hold these positions because I am stubborn. I hold them because I have done the work to understand the businesses, the balance sheets, the competitive dynamics, and the likely outcomes. My conviction comes from knowledge, not faith. It also requires emotional discipline. I do not check these positions daily. I do not react to every negative headline. I focus on the fundamentals and trust that the market will eventually reflect reality. Let me close with some perspective on what contrarian investing really means. Being contrarian is not about automatically buying whatever is down or shorting whatever is up. That mechanical approach is a recipe for disaster. Many stocks are down because they deserve to be down. Many stocks are up because they deserve to be up. True contrarian investing is about independent analysis that reaches different conclusions than the market consensus. It is about doing the work to understand why the market believes what it believes, and then identifying where that consensus is wrong. The market hates the three stocks I have shared with you, but the market hates them for reasons I have analyzed and found wanting. The litigation risk is overstated. The banking crisis fears are outdated. The turnaround skepticism ignores the evidence of improvement. Me conclusions differ from the consensus because I have done different work. I have read the legal filings. I have analyzed the loan portfolios. I have studied the operational data. I have spoken with customers, competitors, and industry experts. This work gives me the conviction to buy when others are selling. It gives me the patience to hold when the positions underperform. It gives me the confidence to add when prices fall further. That is what contrarian investing really is. Not contrarianism for its own sake. Contrarianism based on superior analysis that the market has not yet recognized. The three stocks I am accumulating embody this approach. Hated by the market, misunderstood by analysts, abandoned by institutions, and in my analysis, dramatically undervalued in 3 to 5 years. I expect these stocks to be dramatically higher. The healthcare litigation will have settled. The regional bank will have completed value, creating acquisitions. The consumer turnaround will be undeniable. The investors who bought when these stocks were hated will have earned returns that far exceed the market. The investors who could not stomach owning controversy will have missed the opportunity. I intend to be in the first group. The positions are built. The analysis is complete. The patience is prepared. Now, it is simply a matter of waiting for the market to recognize what I already see. But let me go deeper on the execution of contrarian investing, because the details matter enormously for whether you succeed or fail with this approach. The first critical element is developing an information edge. Contrarian investing is not about blindly betting against the crowd. It is about knowing something the crowd does not know, or understanding something the crowd does not understand. For the healthcare company, my information edge comes from detailed analysis of pharmaceutical litigation outcomes. I have studied dozens of similar cases going back decades. I have quantified the relationship between initial estimates and final settlements. I have identified the factors that drive settlement amounts. This analysis suggests the market is dramatically overestimating the liability. For the regional bank, my information edge comes from understanding the actual loan portfolio rather than relying on sector generalizations. I have analyzed the geographic concentration, the borrower quality, the collateral values, and the underwriting standards. This granular analysis reveals a very different picture than the apocalyptic headlines suggest. For the consumer company, my information edge comes from tracking operational metrics that the market ignores. Scanner data on market share, Nielsen ratings on advertising effectiveness, proprietary surveys on brand perception. This real-time data shows a turnaround in progress that backward-looking financial statements have not yet fully captured. Developing these information edges requires significant investment of time and resources. I have a team of analysts who do nothing but dig into situations like these. We commission independent research. We conduct primary due diligence with customers and competitors. We build models that stress test our assumptions. This is not work that casual investors can replicate, but understanding that serious contrarian investors do this work explains why their conclusions differ from the market consensus. The market is making judgments based on headlines and quarterly earnings. Contrarian investors are making judgments based on deep analysis that the market has not performed. The second critical element is capital structure analysis. When you buy hated stocks, you need to know that the company can survive long enough for the thesis to play out. The most common way contrarian investments fail is when the company runs out of cash before the turnaround materializes. For each of my 3 positions, I have analyzed the capital structure in detail, but that the company generates over $10 billion in annual free cash flow and has a debt-to-EBITDA ratio under 3 times. Even under stress scenarios, it can service its debt and fund operations indefinitely. The regional bank has a Tier 1 capital ratio well above regulatory minimums. Its deposit base is stable and diversified. Even if loan losses spike, the bank has capital cushion to absorb them without threatening solvency. The consumer company has reduced its debt dramatically over the past 2 years. Debt to EBITDA has fallen from over 6 times to under 4 times and continues to decline. Free cash flow is positive and growing. There is no near-term refinancing wall. The balance sheet is no longer a vulnerability. This capital structure analysis is essential for sizing positions appropriately. I can be more aggressive on positions where the balance sheet is bulletproof. I need to be more conservative on positions where financial stress could become existential. The third critical element is understanding the shareholder base. Who owns the stock matters because it affects the supply-demand dynamics and the timeline for re-rating. For hated stocks, the shareholder base has typically been decimated. Institutional investors who own the stock at higher prices have been forced to sell. Index funds own mechanically but provide no active support. The marginal sellers are exhausted because anyone who wanted to sell has already sold. This creates favorable supply-demand dynamics. There are few sellers left. Any positive news can drive disproportionate price increases because there is no selling pressure to absorb the buying. I look for situations where the shareholder base has been completely reconstituted, where the investors who owned the stock based on the old thesis have departed, and new investors with realistic expectations have taken their place. This clearing of weak hands sets the stage for sustainable recovery. All 3 of my positions have experienced this shareholder base cleansing. The tourist investors are gone. The holders who remain either believe in the recovery or are index funds that will hold regardless. This creates the foundation for price appreciation when the fundamentals improve. The fourth critical element is understanding the management team in turnaround situations. Especially, management quality is determinative. A great business with bad management will underperform. A challenged business with great management can be transformed. For the healthcare company, the CEO has over 30 years of industry experience. He has successfully navigated litigation in previous roles. He has a track record of maintaining research productivity while managing costs. I have confidence in his ability to execute through the current challenges. For the regional bank, the CEO has been with the institution for over 2 decades. He grew up in the community the bank serves. He managed the bank conservatively during the period when competitors were taking excessive risks. His decisions look prescient in hindsight, and he has the credibility to make accretive acquisitions. For the consumer company, the CEO was specifically recruited to execute a turnaround. He has done it before at another consumer products company. His playbook of focusing on core brands, divesting distractions, and driving operational efficiency is being implemented effectively. 18 months in, every major initiative is on track or ahead of schedule. Management assessment requires going beyond the public statements. I have met with each of these CEOs multiple times. I have spoken with their direct reports, their board members, and their former colleagues. I have evaluated not just their strategy, but their ability to execute. This human due diligence is often the difference between turnarounds that succeed and those that fail. The strategy might be obvious. The execution is what separates winners from losers. The fifth critical element is position management over time. Contrarian investing is not a buy and hold strategy. It requires active monitoring and adjustment as the situation evolves. For each position, I have defined the key metrics I am tracking. If those metrics improve as expected, I hold or add. If those metrics deteriorate unexpectedly, I reassess and potentially exit. If the stock price rises to fair value before the thesis fully plays out, I review these positions at least monthly, assessing both the fundamental progress and the market recognition. I maintain running estimates of fair value based on scenario analysis. I compare current prices to those fair value estimates to guide position sizing decisions. This active management ensures that I am not blindly holding positions that have changed in character. Contrarian does not mean stubborn. When the facts change, I change my mind. Let me also address the psychological preparation required for this style of investing. When you own hated stocks, you will experience paper losses, often significant paper losses. The positions may decline 20 or 30% before they recover. This is uncomfortable at best and traumatic at worst. Surviving this discomfort requires several things. First, it requires conviction based on analysis. If you buy because someone told you to, you will panic and sell at the bottom. If you buy because you have done the work and understand the business, you can maintain conviction through drawdown. Second, it requires appropriate position sizing. If any single position can threaten your financial security, you have sized too large. The positions must be small enough that you can hold through adversity without financial stress forcing you to sell. Third, it requires emotional discipline. I do not look at these positions daily. I do not react to short-term price movements. I focus on the fundamental progress and trust that the stock price will eventually reflect that progress. Fourth, it requires support from stakeholders. If you manage money for others, your investors need to understand and accept your contrarian approach. If they will redeem at the first sign of underperformance, you cannot implement this strategy. I have worked hard to cultivate a patient investor base that gives me the runway to execute contrarian strategies over multi-year horizons. The rewards of successful contrarian investing are significant. Buying great businesses when they are hated and selling when they are loved generates returns that far exceed the market over time. The key is being right about the fundamentals and having the patience to wait for the market to recognize what you see. The 3 stocks I have shared with you today represent my current best ideas in the contrarian space. Companies with real assets and real cash flows, trading at depressed valuations because of temporary problems and excessive pessimism. I cannot promise these investments will work. Every investment carries risk. My analysis might be wrong. The catalysts might not materialize. The timeline might be longer than expected, but I can tell you that I have done the work. I have analyzed the businesses, the balance sheets, the management teams, and the market dynamics. I have concluded that the risk-reward is asymmetric in my favor, and I have built positions large enough to matter but small enough to survive adversity. This is contrarian investing as I have practiced it for decades. Buying what others hate based on analysis others have not performed. Waiting patiently for the market to recognize reality. Earning returns that reward the discomfort of going against the crowd. The positions are built. The thesis is clear. Now we wait and see whether the market eventually agrees. In my experience, it usually does, not always, not quickly, but eventually, stock prices reflect fundamental value. And when they do, the contrarian investor is rewarded for having the courage to buy when nobody else would.